Tesla has just traded under the 200 daily moving average. We're going to find out why that is bad for risk generally and which FX pairs this might translate over to. And then the trade in takeout today is going to be why trading is not economics, but economics can kind of be like trading. But before we get into today's video, please just go and do me a favor, click the subscribe button, like this video so I pop up in your YouTube feed every day to give you the best market tips and commentary to improve your trading edge. I don't think Tesla needs much introduction, but if you have been living under a rock for the last decade or longer even, Elon Musk's car company just traded under the 200 daily moving average on Friday, in fact. So Friday, we had a big close below it. On the Thursday, we bounced and closed well above it. I think there were a lot of trapped longs there, getting long, thinking that we're going to bounce higher, and then we've absolutely collapsed through. Not good for risk sentiment. You know, Tesla is one of the biggest weightings in the US stock market complex, you know, whether it's on the NASDAQ or the NYSE, and then as a function of that in the index, you know, the Standard & Poor, S&P 500. And so based off of this, we've got to start thinking, okay, what is the risk sentiment generally then? What has changed? We've entered a new year. The volumes have picked back up again. We should now be able to, you know, form some sense of direction. And we can see exactly sort of what's happened. So here's the collapse through the 200 daily moving average. And similarly, you know, on Friday, Aussie started collapsing as well. I actually thought we'd bounce here and then see a tick up because I thought the market was a bit stronger than this. But no, we've just gone completely through. Now, a lot of this trading could be a function of the US being shut yesterday, of course, you know, less liquidity. So the market's falling through. But we're seeing a continuance of this today as Europe's opened. You know, you can see this big drop off here of about 40 odd ticks there. So, sorry, even more actually. Sorry, I've zoomed all the way out. Let's have a look here at exactly how far it's fallen. So we're down, you know, 66 basis points there. That's a lot for an opening market. That is a hell of a lot, especially in the Aussie. Obviously, there's overnight trading. There's going to be more concentrated trading in the oceanic currencies. But for the Aussie to collapse like that is really, really telling. And, you know, if we are looking at risk sentiment generally, looking at, you know, the likes of Tesla, the higher weight stuff, let's see what Apple's looked like as well. Apple was fine at the end of last week. So no real issues with the biggest weighted stock. But I would be concerned, and I would be saying that last week's close has led to some form of change in the market. I think what we start seeing is a lot of momentum readjustment. So what happens generally with systematic targeting of, you know, algorithmic funds and things like that is they will see the higher weighted stocks. And if it starts changing momentum from where it's previously been, they'll start closing off their positions. Now, you have to imagine that this can cause a cascading effect. If the higher weighted stocks are all doing that, and remember, there's only 7 stocks that make up the Magnificent Seven. 7 stocks make up between 33 and 40% of the movement of the S&P 500. Terrifying statistic that to consider that we're controlled basically by 7 stocks all the time. Those 7 stocks are Apple, Microsoft, let me get this right, Tesla, Nvidia, Google, Alphabet, and I can't remember the last 2. Honestly, it's very difficult. I think I said Nvidia, didn't I? But there's a couple more. And yeah, so these are, you know, the stocks that are literally moving the market around all the time. So it's going to be very interesting to see what happens on today's open. So Friday's close was really, really instrumental, I think. The 200 daily moving average, as I mentioned yesterday, with regards to you know, formulating a certain strategy. Vital here, you know, this is a weak bounce for me. Like if I were to put some volume over here, and this is probably a nice little lesson to look at as well. If we're to look at some volume here, you can see the decline in volume as we approach sort of a push higher here. it completely goes. You can see it just falls here. So lots of buying here, but then it's not sustained. Whereas if you look here, the buying is increasing and increasing. Do you see that? So what we're seeing here is a market where, the buying's going, the market's going up, but the buying's not being supported by actual intent behind it. And that is absolutely key, especially at an area of business like this, an area where the 200 daily moving average is targeted by a hell of a lot of different funds, a hell of a lot of different people, CTAs, whatever. That is an important thing to note. So whenever you do see declining volume after a bounce like that, expect the market to do something strange. Like even here, you can see it. So we get the bids up, but then it declines, and then we see a little drop off here. But the difference between here and here is that this is where the 200 daily moving average is, and this is where you would expect a bigger and broader bounce to occur. So I'd be very, very cautious currently. I think I've got this on a log chart. Yeah, let me make it regular. I'd be very, very cautious at the moment. Now, translating this over to FX, you'd want to be looking at the Aussie dollar. You'd want to be looking at sterling dollar as well. You can see that they've all fallen off. All of the risk-sensitive currencies have fallen off. I think the euro has as well. So we're waking up today to a new week, and the dollar is very, very strong. If we look at, Kiwi dollar, it's the same all around. These are key lows here. These are new, fresh lows for the year. So this is where the momentum is. It doesn't take a rocket scientist to say, if we go down to a lower time frame, it doesn't take a rocket scientist to say that, look, where's the market headed? The market is headed. I always forget where the arrows go. Here we go. Market is headed this way, right? So why would you try and, fade that generally? You'd maybe want to look here if you're looking at the Aussie, seeing what happens here, but we've already touched there. So this level's basically been taken as well. It didn't want to push higher. If you go even down onto a smaller time frame now, go down to 5 minutes, you can see, and this is actually a pattern that I quite like. When you get a triple low like that, that's all equal, you tend to see something like this. And then you absolutely dump all the way through. So bear in mind where the direction of travel is at the moment, because it's all one way. It's one-way traffic, and it's all supported by, and I think it's relevant to understand the reasoning by, I would argue, momentum coming in equities. I don't think I've got live data on this at the moment. I think I had a new card, so you can see the S&P. This is 15-minute delayed, but you can see how even on the daily the S&P's down. So this is all contributing to these moves in FX, and I think I'm relatively certain it's from the move on Friday, that really, really low close, especially in Tesla. There's probably a couple of other stocks as well. Let's check out Nvidia. Nvidia fine. Microsoft fine in Microsoft. Let's check Walmart. WMT is Walmart, isn't it? Gosh, sorry. Walmart, fine. It seems like Tesla is doing the heavy lifting there. So pay attention there, I think. Watch your FX pairs. The direction of travel for the moment is to the downside. Watch for any changes in hike sentiment. And these are things that you just have to focus on throughout the week as we're going on here. Question that I saw on Twitter earlier today, and it was basically from someone named Ewan Sinclair, who is literally an options wizard. Like, he's spent a massive time trading options in his career. He's fantastic, written textbooks, everything. He's fantastic. Give him a follow. But he was basically saying that whenever traders try and do economics, they get things wrong, effectively. And I kind of agree with that. I'm very much macro focused, but from a different perspective. I always mention to you guys about looking at the element of surprise. What is the extent or the element of surprise from one data point to another? Now, the reason why I look at this in this way is because it's very different to how an economist might look at it. An economist might look at an inflation print that's higher and say, okay, this is exactly what's going to happen because that's by the textbook. However, markets do funny things. Markets do things like pricing things in earlier before the event. Markets do things like caring more about one piece of data over another because the context changes. Markets also care about positioning and things like that. So these are all things that economists wouldn't necessarily take into account. So from this perspective, I would agree with Ewan in that, markets aren't the economy and economists can't necessarily do trading. But from a different perspective, it's about shifting the view on how economics and trading work together. I think that is absolutely key. And the number one way that you can do this is start looking purely at how the extent of surprise is the important thing and not the actual data itself.